Economist, the Fed releasing its Beige Book survey at the top of the hour. In it, most of the 12 districts were positive about the economy's outlook, though some businesses surveyed, such as those in the Chicago area, were cautiously optimistic. While the Fed's optimism over real estate was more muted, mortgage applications are up for the second straight week. Joining us to discuss this, Jay Brinkmann, chief economist for the Mortgage Bankers Association. He's in our Washington newsroom. Mr. Brinkmann, welcome to back to Bloomberg News. Always good to have you on.
Good to be with you, Mark.
Mr. Brinkmann, we were just talking about the Fed's Beige Book, so why don't we start there? The Fed report saying economic activity continued to expand moderately from November through December. What's that tell you about the housing market?
Well, that's going to be the key to any improvement of the housing market, because the economic activity will eventually translate into some reasonable increase in the number of jobs, and the jobs, in fact, will end up driving what kind of number of applications to purchase homes. At some point, people with jobs are going to say, gee, I really would like to own my own home. That's when we'll start seeing the pickup, is when this activity translates into job creation.
Mr. Brinkmann, and we should mention, you know, that really is key, because we have seen that the real estate market has been adversely affected because of this stubborn unemployment rate. Still can't get below 9%.
That's it. And if you look at the different areas where we continue to have problems, it has been areas that have suffered some of the biggest losses in construction employment, manufacturing and employment. Other areas that have not seen the big drops in employment really haven't seen the big drop in home values, and we've seen the markets hold up pretty well. So it's very much going to play out as a regional story as we go forward. In terms of the mortgage applications, we are up a little bit over the last several weeks on a seasonally adjusted basis. There's a little bit of concern, though, that we're still down on a year-over-year basis. That this time last year, we were in between two tax credit programs. People had sort of jumped to buy houses in the fall. Perhaps they were sitting on the sidelines waiting for another program in the spring. There's no prospect of any tax credit program around, yet the purchase applications are lagging this time last year by a little bit.
We should mention, again, home purchase applications falling in 4 of the past 5 weeks. And again, this was because the real estate market adversely affected by those high unemployment rates. But we're still seeing more foreclosures. How much pressure is that putting on property values?
It's putting a tremendous amount of pressure on property values in particular markets. Keep in mind that about 40% of the homes in foreclosure are located in Florida and California. So it still has a tremendous pressure in those two states. In California, certain parts of the state. In the rest of the country, yes, at the margin, it's going to be an issue. But I think that's again going to be balanced against what growth is taking place. You could actually have a fairly low foreclosure rate, but if you're still losing jobs, if population is leaving, like we're seeing in some of the Midwest states, that's going to put pressure on home prices as well. Of the drivers, I'm sorry.
No, I'm sorry, Mr. Brinkmann. When that economy does finally turn around, because we were talking about the Fed just a moment ago, the release of the Beige Book at the top of the hour, the Fed's going to raise interest rates. Is that going to help or hurt the housing market?
It's probably not going to have as big of an impact on the housing market as some people fear. When we're talking about rates going up, we're probably talking about rates getting above 5%. A few years ago, if anyone had said rates were going to get down anywhere close to 5%, they would have said that's a tremendous stimulus to the housing market. So it really depends on where you're coming from. Right. Really, the effect is it determines on how big of a house, how big of a mortgage payment people can take on. Right. They have X amount of dollars, so how much they can buy depends on rates. The big determinants, I think, are going to be what's the availability of credit, what are some of the controls now that are being put on to down payment requirements, some of the regulations now coming out of the Dodd-Frank bill that lenders are faced with, and also coming out of this recession. Just because someone has a job, do they in fact have the credit to do it? Finally, I think there's an, I'm sorry.
I'm sorry, sir, but we have about 30 seconds left, and I just wanted to get in and ask your outlook for mortgage rates going forward here in 2011.
Mortgage rates will continue to go up. We're not seeing drastic increases, but by the end of 2011, we should be a little bit above 5%, a little bit more than that. Largely, I think, determined by the international markets. Some of the discussion on China, Europe, that's going to be the headlines driving mortgage rates through the rest of this year.
All right, Jay Brinkmann, Chief Economist, Mortgage Bankers Association, staying with us through the commercial break in Washington. Mr. Brinkmann, thank you so much. We appreciate it.
Thank you. Thank you.